Good afternoon. Hey guys, today we're going to be talking about interest rates and the forecast of 2022. We're going to be talking about home values here in San Diego, and we're going to be answering some questions. So if that's what you're looking for, then right now, definitely need to be watching this live, and we're going to be going through all of that and plus some of the new limits of what is changing my clients' actual prices and what's also changing their down payment. So we're going to get after that right now. Good evening, guys. My name is Liz Hfa here with the MortgageLiz team, and if this is the first time to my channel and you're looking to learn some information about what it's like to live here in San Diego, learn more about home values, and learn what the mortgage process is here as well, then you're definitely going to want to hold on and learn a little bit more about what we're talking about here today. So this is going to be our first go around, and for everybody that's watching, bear with me. We are definitely learning this process, to say the least. What we are definitely going to be discussing today is going to be this week in real estate and what's been happening with inflation, demand, rates, home values, and why we're not in a bubble, as well as to know why we're sitting where we're currently at with regards to the raising of interest rates plus the raising of our home values. So with that being said, we're going to get started here on our first week in real estate for 2022. So as we go here, so getting started here with our interest rates and the perspective of what the experts are actually saying, we're going to be discussing today the housing market and really where the rates are right now. Mortgage rates are continuously, obviously, rising. If anybody is actually watching some of what's happening on the news, you're going to see that. At the same time, you're also going to see some of the differences of the news. In one website, you'll see that the rates are declining, whereas on another website, you'll see that the rates are actually increasing. So you just want to be aware of what the experts are actually saying, and then also see behind whatever that low interest rate is and how it's actually going to be affecting your actual payment. Because too many times right now, I'm actually finding that the interest rates that we're dealing with that are really low come with a lot of cost. And so what we're talking about today on the mortgage rates and the sideways of heading into 2022 is that the rates that we're doing right now are just the base rates. So what that means is that you're not paying any extra money to be able to get the rates that exist right now. You can always buy down your rates just like anything else. And I'm sure if you go into a little bit more dive, which we're not going to do today, depending on how much you spend for that rate will depend on whether it actually really makes sense to actually get that interest rate. So when you're looking at the last several months here, we're looking at our current rates at a 3.11%. This obviously is based off of what we have here from the chief economist here from Freddie Mac. What he's said here is showing mortgage rates have effectively been moving sideways despite the decrease in new COVID cases. This is because, I'm going to just move around this screen here. This is because incoming economic data suggests that the economy remains in firm ground, particularly cycle industries into manufacturing and housing. Moreover, low interest rates, high asset valuations continue to drive consumer demand, while we expect the rates to rise. The push first-time home buyer, a demographic that's been propelling the purchase market, will continue to go to 2022 and beyond. So as we're discussing mortgage rates here, this is what it's going to look like through our graph, looking here from the sideways perspective, painting that from the black arrow that we're looking at right here, that the 3.1% may be a little bit low based off of where we're currently at, especially off of what happened yesterday on our currently market. But it's hovering over this just about, with still very good financing at a 3.11%. The other thing that we also want to be aware of is that based off of this right now, if we were to actually go back in 2020, go into February, over here in April, you're going to end up finding that the rates were significantly higher. So while we're here at the 3.11% today, if we go back in 2020, we are still a lot lower than what we were in 2020 pre-pandemic. So while rates are not in the twos as much anymore, as we can see here on the mortgage rate projections from 2021 in December from Fannie Mae, Freddie Mac, MBA, and NAR. It's important to be able to project that the payment that you're looking at is what you need to be most important about, not so much the actual physical number to your interest rate, because at the end of the day, what we're paying for is not the actual rate, but in fact, we're paying a payment. So we need to be comfortable with that payment first. So what we see right here, the experts are showing time by the end of the year of 2022 between the 3.5% to 4% margin. Now, I'm not trying to forecast the rates. I'm not trying to say that this is exactly what's going to happen, but this is what the experts are saying, and so that's what we are going off of. Make sure that when you are talking to your families and friends that, in fact, the information that we're talking about right now is the conversation that you, in fact, are actually having. Too many times we're talking about a bubble, we're talking about the rates are going to go back down, or projecting what we actually think. That's why today we're discussing what, in fact, the history shows, while, in fact, what the experts are also talking about here in the economy as it is improving. So, house prices, existing homes sales have historically been resilient to rising mortgage interest rates. Right now, rates are really what we talked about at that 3.11%. Even we talk about the rising rate environment to be able to buy a home at 3.5% or even 4% historically speaking. Remember what we talked about just a second ago, that in here, we're showing that rates have historically been a bit higher, okay? So it is important to realize where we are currently going and what we're actually expecting as of today. One of the conversations that we were talking about was forbearances, and in forbearance, we want to be able to see that they are finally falling below 1 million. Monthly numbers of low here is in the active forbearance. And you can see that back in 2020, right over here in May, we were over at 4.76 million, going all the way down to October, and then going into November, December, which is here in 2021. Still significantly decreasing. And if you notice, as this is decreasing, a lot of the time, a lot of these people have actually just been able to finish up either the forbearance, paid the amount due, or just been able to sell the house so that way they were completely current. Right now, a lot of the people that are actually owning their home, you will end up finding that they have a significant amount of equity. We will be discussing that in the future lives as well, so that way we're all on the same page. But in December, 890,000 mortgages is now the number. So here at 890 represents a 1.6% of active mortgages. On news, you're starting to see in other places that this wave of foreclosures coming is really not going to be coming. It's not what we're expecting, because as you can see from the original in 2020, where we had over or almost 5 million people that were in forbearance, we were expecting a big, huge foreclosures here and where we were going to have a lot of home values drop, and that's not what actually happened. Because of all the options that sellers have today in today's market, you know, if someone's in trouble, they could just sell their home. The average person right now does in fact have a significant amount of equity, very different than where we were in 2007, 2008, 2009 in the height of that market. The most recent information as the end of November loans existing in forbearance, you show here in the screen area here that 38.6% of the loans were paid in full. They either made their monthly payments that they were supposed to, they paid off the loan entirely, or just paid off the past due amounts. But in general, they completely were brought current. The next section in the light blue section right over here, what happened was that in becoming the biggest section of the 44%, they've gone through some kind of loan modification, type of deferral, or tacking on the amount that they actually owe to the end of the loan. The bottom line here is that 4 out of 5 people coming out of forbearance either didn't need it or were getting a workout plan. They came out of it whole, meaning they were now even Steven when it comes to the amount due to that bank. I'm not saying everybody is in this situation, but the equity in homes across the country mean that they can sell it right now and not have the issue of the foreclosures. But some money in their pocket, of obviously whatever the situation may be. 17.4% is what we're looking at right over here in pink, showing right in here we're still not in trouble. We're still in trouble. We're not saying that we're going to go into forbearance, but they either don't have a loss mitigation plan as of right now. But in comparison to the whole pie, 17.4% in comparison to 38.6%, and the 44% is very significantly different. Also finding that, in fact, the foreclosure rates in 2022 are not what we were actually expecting. So as we see here, we may see a little bit of an uptick in the foreclosure rates in 2022. Just an uptick, though, from an extraordinarily low level. We're not expecting to see a big increase. We expect delinquency rates overall on home mortgages to actually continue to remain quite low, is what we're expecting. So when we look at CoreLogic, which is how we decipher our numbers, foreclosure rates going to remain low. It's important to piece of information to keep in mind when you're talking to your friends and family, wondering about what's going on with the foreclosure rates. The equity in the homes today across the country is giving people a lifeline that they didn't have back in the housing crisis. So showing here year over year our demand, we're just going to go a couple more information, then we're going to go into our questions. So if you do have questions on our live, feel free to put them down in the comments. We're going to be pushing those forward. And then of course we also have different questions that come along from the week of the team here. And so we're going to be doing that as well. So as we wrapped up the end of the year, the holiday season showed time came out of their year over year demand. Impressive year over year demand can be seen all across the U.S. coming out of showtime on the average across U.S. average over year demand heading into the holiday season. Most recent information has been published by ShowingTime at 12.5%, just acknowledging that in fact the homes are being actually shown even during the holiday season. A lot of the time we find that that during the holiday season it kind of slows down, which is in fact very true. However, that does actually get changed a little bit more specifically towards the people that are actually wanting to purchase the home. I found a lot of my clients that were actually able to get their offers accepted more so during the holiday season because the people that were trying to sell, so the sellers that wanted to sell, were in fact wanting to sell. The buyers that wanted to buy wanted to buy. So meaning that they were not so much wrapped up into the holidays and they were willing to be able to purchase their home right now. So here at the graph showing home prices are expected forecast to increase by 5.7% here. If you look at where we were in previous years, we were increasing 3 to 4%, increasing at 5% right in the middle, up to 7%. Last year we were at the 12% range. Right now we are expecting in the next 2022 that we are still forecasting to go up to that 5.7%. Keep in mind that while it's not as crazy high in comparison to values that we were dealing with in 2021. It's still going to keep going up. So seeing a bubble is not what we're going to be expecting. Increasing home price appreciation may encourage existing homeowners to use that equity to purchase a larger and more attractive home, a dynamic known as the wealth effect of rising equity, which is already happening in some extent. So you know that the average person did have an increase of value to their home of about $50,000. Here in San Diego, that average increase was significantly more. There are some homes, when you look at the average price of a $500,000 home or a $600,000 home, that $50,000 increase was significantly higher. Whereas maybe that you were looking in the middle of San Diego, downtown San Diego, La Jolla, Encinitas, things like that, you'll end up finding that you did have a bigger increase when it came to values. So overall, I do think that 2022 will be an extraordinarily another strong year for housing and be a little bit higher mortgage rates. Of course, we do think home sales will continue to rise and actually reach a 16-year high in 2022. This is something that was said by Ms. McClare Bolton from the senior leader of the research in CoreLogic. All right, guys, so with that being said, I want to be able to give you a little bit more information when it comes to just the questions that we've been dealing with this week. Also want to be able to share some of the additional things that I've actually been reading about when it comes to different articles. So we're going to share that as well because truly there is some information that you listen to or that you hear, and I feel that it is just not as accurate as what we expect. Some of the information that we want to be aware of, though, number one, is going to be the changes in our value, in our loan amounts. So right now we are sitting here in San Diego. So in San Diego, we're looking at increased loan amounts at $879,750, and then also looking at our higher amounts for Riverside right over here at $647,200. I was actually talking to a client that was actually looking at Los Angeles, and in Los Angeles, it is a significant difference at $970,800. So what does this mean? Well, 2021, you were only able to buy in San Diego right in here, right here, it was at $753,250. So at $753,250, that was the maximum loan amount to be able to just put 5% down. With this new increase, now we're talking about over $100,000 higher of a loan amount to be able to just put 5% down. So whereas we would typically go into somewhere in the realm of about $823,000 on that 5%, $879,750 is going to take us all the way up to $926,052. So when we're starting to look at the increases when it comes to Los Angeles, when it comes to Riverside, those are significantly different. We start looking at Riverside in itself. Riverside for a really long time had a much lower loan amount. So it was significantly harder in some cases, depending on the type of loan that you were doing, whether the amount of down would be sufficient. I was finding a lot of my clients where their 3.5% down wasn't enough, and it wouldn't cover as much house that they wanted, so they had to do a higher down payment, 5 or 10%, because the FHA wasn't going to work. So there's a lot of that information for today, but we don't want to go too much into it. But I just want you guys to be aware that San Diego, as that loan amount has increased, future videos that we're going to be talking about, of course, and then looking at Los Angeles, which is the other increase that we have right over here. This will make a significant difference. Specifically talking about a client that I was working with today, originally their limit was in the 800 range. I believe it was about 833 to the county that they were doing. Now they can go here at this 970,000. This allows them to use less of their money down that they were going to use from the sale of their home that they're doing right now, and that they could use more of that money to be able to pay off debt and to be able to renovate the house. So whereas originally they were going to have to put the money down from their profit from the house to be able to buy their new house and use the majority of that money, now they don't have to do that. They can actually separate it because they don't, in their case, they needed a regular loan, a regular Fannie Mae loan. They were not going to be able to get into a jumbo financing for their situation. So this gives them that ability because of the new limits. Again, more videos to come when it comes to this. The other thing that we want to talk about here is our rent as it is increasing. So in the comments, you're going to be able to find the blog for ourselves. And then here, this is one of the most recent articles that you're going to end up finding. In this article, it talks about avoiding the rental trap in 2022. Right now in Escondido, the rent in general, from what I've noticed, is increasing significantly, anywhere between 5 to 10 to 11%, depending on your situation. And I mean this very hardly, is that depending on your situation, I've had some rent where it was just significantly lower than where the market is, that they're going to be raising it from $2,800 to $3,500. While yes, technically there are some situations where that cannot be done because there are laws against that. That's not something that we're going to be discussing today. That's something that they do have to go through with their landlord and then dispute all of that information. So I know that in some cases we just go, oh, well, you can't do that. But there's more to that conversation. There's now you're dealing with that landlord when it comes to that rent that they're increasing. So when we look at this, the median asking of rent in 1988, we're showing that they were a lot lower. Let me just make this lower again. There we go. So as we're going here, let's try that one more time. So here we are, just showing that in 2021, rents grew dramatically. This is all based off of apartmentslist.com, basing on January 2021. The national median rent has increased, staggering over 17.8%. Also, the context rent growth from January to November has gone over 2.6% pre-pandemic from 2017 to 2019. Then when you look at the increasing 2021 here, there we go. We expect a trend again from the fuel rental growth here at the national level, with we're forecast renting growth at 7.1% in the next 12 months. That means if you're planning to move into a different rental this year, you'll pay far more than what you're going to pay right now. So when you're looking at buying another, or renting a new location, you're going to end up noticing that you are going to end up spending quite a bit more. If you're facing rising rental costs, you'll notice that alternatives you have raising rents across and consumer prices may have some prospective buyers seeking the protection of a fixed consent mortgage. So as when we look at this information, it's just important to be able to see that there are going to be increases when it comes to rent. One of the most recent things that I saw was regarding the rents that were increasing here in San Diego, specifically here in Escondido. So like we just saw right here, talking about the rent rising here, and then the staggering of over 17.8%. Moving on to the next thing, this one I actually, I just heard about, and it's I found it on CNBC. They're talking about the solar. You want to be aware that the solar spiking is actually changing. More than half of 2022, solar projects threatened by spiking costs. New reports are finding that you're going to end up getting less money back or less money out of the actual solar. Too many times we actually find that solar, in fact, does not benefit the consumer, does not benefit the homeowner, because they're not using enough electricity for it to actually make sense. Or the system that they're actually buying, they did not buy it big enough to the point of when it's actually going to work for them. So what does that actually mean? So right now, the electricity that you're actually using in comparison to where the electricity would be if you were turning everything on is significantly different. One of the things that I've talked about on this channel a lot is the fact that the way that my system was built out in comparison to the way that other family, friends, clients have built their system out is that the system that they had either didn't cover enough, wasn't large enough, or wasn't able to projectively assume what you were going to end up having in electricity usage once you actually turned everything on. And so I've had too many clients where they actually get the solar and then it doesn't cover that amount. And now it's going to be even more so because surging solar costs here, driving more the raw material price increases, obviously based off of supply and demand, are half of 2022 expected utility solar build out. New Year's forecast of 90 gigawatts. Utilities saw Tuesday at 56% of the projects at risk amid the surges in prices. Scrolling down just a little bit more, all told, the cost of the photovoltaic modules rising nearly 50%, under 20 cents per watt. A portion of the surging cost is thanking to the jump of which the components of the solar systems. Also, the materials are up over 300% in 2020. And then looking up more than 200% here in October of 2020 as well. So really realizing that the cost of solar in general is going to be more expensive, while at the same time, because it's going to be more expensive, the amount of money that you're actually going to get back from it is going to be very different. The utility solar industry is facing one of its toughest challenges just day just days ahead of COP26. They said that the current bottlenecks are not expected to be relieved within the next 12 months, meaning developers and off-takers will decide whether to reduce their margins, delay projects, or increase off-take prices. One thing that you are probably very aware of is that solar is actually really common now in new homes. I've actually read a lot about how they're actually required now. It's not something that I deal a lot with new homes as much, just because when you are dealing with a new home, a lot of the time my clients will start at the new home, like the homes, like for example in Valley Center or Canopy Grove, that's actually in Escondido. But they start looking at the HOA and the Melrose, and they realize that that cost doesn't make sense. Something that I tell that you've heard on this channel is referencing the amount of money for $150, how it references to the amount of house. So, for example, today I was talking to a client that was looking at Canopy Grove, looking at HOAs of over $200 a month, then looking at the Melrose that in total would calculate out to over $500 a month. So when you start spending over $500 on HOA and Melrose, remember Melrose is that special assessment, the special taxes, you're going to end up using more of the purchase of a house to be able to actually pay in that HOA and Melrose. So what does that actually mean? Remember the $150 to the $30,000 in house. In this equivalency for him, it was $500 in payments equaled $100,000 in a price of a house. So where he could be looking at a $700,000 home, in fact, $700,000 home for the HOA of $500 and have the same exact payment, or look at an $800,000 home with the same exact payment. You and I both know that when looking at $700,000 and looking at $800,000, you're going to be in two completely different situations when it comes to what the home actually looks like. The inside, the backyard, and also the updates of that home. One other thing that we want to be discussing here on the solar is that just be aware that the solar in general, it is very difficult to be able to transfer. It has gotten a lot easier when it comes to the solar and transferring in comparison to prior years, but it's not the same as to how it is. I'm sorry, it's not the same to how it is today. Today is a lot easier in comparison to the prior years. Prior years, I ran into a lot of clients where they weren't even able to change their loan because of the type of solar or how they set up the solar. That goes up right up there with the PACE and the HERO, which is, again, another topic for another day as we are going here on our live. So, and then the last bits of information that we're going to be discussing today is actually going to be the questions that came up this week, and I want to be able to add that in today so that we are all on the same page. Every single week we're going to be going on live here on YouTube, so that way you can not only get educated with everything about San Diego, about real estate and everything mortgage related, but also be able to answer some of the basic questions, so that way it makes it a lot easier. So that way when you are ready to make that change, make that move to buy that home or refinance that home, that you are very well educated. So first off, we want to talk about units, 4 units versus 8 units. So if you were thinking about buying an investment property, the difference between buying 4 units, which is basically 4 homes connected to each other by a wall. Sometimes they're not connected by a wall. Sometimes they're all sitting on the same piece of land. And then there are 4 little houses, but they are technically 4 units. So that is a quadruplex. A quadruplex has different financing than an 8-unit home. So 8 units, think of like an apartment. That's what my client was actually looking at, was an apartment building that was actually located in Los Angeles versus 2 quadruplexes that were in San Diego. So what is the difference between these two? First off, the 8 unit is technically commercial zoning, commercial home, which means that you have higher interest rates, larger down payments, and very different terms. In some cases, you'll be able to actually do 30-year fixes, and that won't be an issue. In some cases, that's not the case. You end up finding that you'll end up having terms of the loan that you have to actually refinance or get out of the loan, a quick term of the loan that you originally got with the commercial financing. Okay, flip-flop, going into 4 units. 4 units is very different. The down payment Could be anywhere between 15, 20, 25%, depending on your credit score, your situation overall. You're going to end up finding that the 4-unit, in this case for my client, he was able to buy 2 4-units, so 2 quadruplexes, for the same amount of down payment to be able to obtain more cash flow, so more rent from the 2 quadruplexes than he was going to be able to do between the 8 units. So why is that? Well, in the quadruplexes, he ended up having lower interest rates. 2, he ended up having a lower down payment. So he's able to push it into 2 different homes versus just the quadruplex or just the 8 units. Because the 8 units did have a bit of a higher interest rate. And then he was using more of the money from the sale of his home, which is a 1031 exchange. We'll talk about it another day. But in this case, he was being able to use the investment money from that house to buy 2 of these properties to be able to make this work. So the big difference between quadruplexes and 8 units is in fact the down payment, the interest rate, and then just in general the commercial, the lending of it in itself, and then who it ends up with. It doesn't go to Fannie Mae, Freddie Mac. It doesn't have those typical lending that we end up using on a regular basis for us to buy our homes. That's not the way that commercial loans are done. So next question that I had today was with regards to the HOA and the Mellorews, and that was briefly what we were talking about today with regards to that $500 to the $150 to the $30,000. We just want you to be aware that when you are in fact going to be buying a home, that you look at that HOA, you look at how much that amount is, and realize that it's not going to stay there forever. Not that one day it's going to go to zero. No, meaning that the HOA that was originally, let's say, $150 will not stay at $150. For example, my HOA, I've lived in my home for almost 14 years. In this home, it started at $149. It got as high as to almost $200, and now is back down to $152. So in the course of 14 years that I've owned my home. So it's not going to stay there the same amount. Other aspect is that when you look at a condo with an HOA, depending on how much money and how well they do their budgeting, your HOA could pretty much stay the same. However, that's not always going to be the case. If they don't manage their money correctly or as well as it needs to be, or they have these big expenses within the condo or the association, you will end up getting an increase to your own HOA. So that way you'll be paying, let's say, more. You'll pay $300 one month, and then let's say $400 next month. Depending on how your CC&Rs are dictated will depend on whether they can pass on the entire expense that they just obtained. Next thing that we want to talk about is down payment assistances just a little bit. So in down payment assistances, typically we're talking about Cal Hfa and also the Golden State program as well. So briefly talking about the Cal Hfa program, and realizing that when we look at this program specifically, rates are significantly different. So we're going to share my screen here again, so that way you guys can actually see where in fact the rates are today. So when we look at Cal Hfa, this is what you're going to be looking at. Rates are significantly higher than what, and I wouldn't say significantly, but yeah, they are definitely higher. When you do a down payment assistance with the California Housing Finance Agency, you will end up paying a higher rate. So put it in perspective. Right now, if you were to do a, let's say an FHA loan here, you're looking at getting the 3% from them, which is a ZIP loan, which is a down payment assistance. We'll talk about this a little bit more into another live, but you get, you obtain the second mortgage, which is the 3%. And then you get here the third one. So you have 3 loans, which is my home. And then you end up being able to now get in total 2 programs that help you, which is great. Don't get me wrong. This is an amazing program, but it does not work for everyone. This last week, I've been having a lot of clients talking about what is a down payment assistance. Can this work for me? And in fact, this is an amazing program, but it does not work for everyone. If you have your own money for the down payment, you will actually end up finding that you are better off using your money than using this money from the down payment assistance from the state of California. So why is that? When you look at the interest rates that we were just looking at now, we're looking at rates at 4%, 3.5%, and 2.75%. These are just base interest rates, not including additional closing costs, not additional fees that you're going to be looking at. And so when you start looking at that aspect, you end up realizing that because you have to pay 2 additional discount points, 2 additional points to be able to get either one of these programs, this ends up being very costly. So you don't, in fact, end up receiving all of the money that you get from the down payment assistance from the state of California. So let's put this in money amounts perspective. So if you were to get a $600,000 home with a zip loan here, the money is going to be based off of your loan amount. So for quick numbers purposes, we're just going to go 600,000 at a FHA loan minus your 3.5% plus your 1.75%, which is your upfront mortgage insurance. We're looking at $589,000 is your loan amount. So $589,000. When you do an FHA loan for this program specifically, they're going to charge you 2 points to this loan. So 2 points to this loan, we're looking at here at $11,782. So $11,782, you're actually spending $11,000, $11,700 to be able to get the zip loan. And then you're going to get the My Home loan. Okay, so last I checked, My Home loan, I believe, was giving you $10,000 or $15,000. They've recently given you just a little bit more for this program, but nonetheless, here we are. So we're going to share this one more time. Here, the Cal Hfa gives you $15,000 or a 3.5% in monies here. Let's just move this around right over there. That it does give you that $15,000. This is the My Home program that we're just talking about right now. But when we look at the down payment assistance program from Cal Hfa, you would end up getting this one, which gives you the $11,000 in fees. And then you also do get the 3%. So it does give you money from this program, but you still have to pay fees to both of these programs. So when you're paying $11,000 in fees and you get 3% of the sales price here, you end up not getting about $18,000 plus $15,000, and we're looking at like $23,000 on a $600,000 loan. Of course, these are not down to the penny accurate numbers. We are doing rough numbers here on our live. But when you look at these numbers, you're looking at about let's say about $25,000 for easy numbers. You're spending $11,000 to be able to get this money. So 25 minus 11, now you're at $14,000. That is actually getting used to go towards the down payment and the closing costs. So if you have no money for your down payment and no money for your closing costs, then yes, this would help you. However, when rates are lower than what you're looking at right here at 4%, then that's where this starts to get dramatically higher. I mean, you end up spending more money here to be able to get this program right now for the closing costs and monthly for the term. So it is your kind of easy way in, because if you have less money, but if you have the money, which is exactly what I was explaining to my client, if you have your own money to get the down payment, you overpaying for the program here and then getting charged more on interest rates does not mathematically make sense. So logically, you want to be able to pay your own money for your down payment and your closing costs. And so then last conversation was with regards to mortgage insurance. So mortgage insurance, I did have a client just recently talk about how it's going to kick off with regards to FHA or conventional. Just realize that one just tidbit, depending on the loan that you're doing, will depend on when it actually falls off. So if you're doing an FHA loan, if you're putting less than 11% down, you're going to have mortgage insurance for the full 30 years. Again, there's a video here on my channel that talks more about this, but the other aspect was he was referring to, well, what if he just put all the money to be able to get to the 20% down, let's say 6 months after you owned a home? Well, that would be okay and be able to remove your mortgage insurance because you're automatically reducing the balance. But again, you need to check with your lender, check with the actual investor that you actually have, because not all loans actually end up with Fannie Mae or Freddie Mac. And a lot of loans do have separate investors, even though a majority of our loans end up there with Fannie Mae and Freddie Mac. If you have a VA loan, of course, you don't have mortgage insurance. You'll have a funding fee, which is applying to you. When it comes to FHA, that's when it's going to stay there for a really long time. It's either going to stay there for the 30 years or 11 years. It depends on the type of or how much down payment you actually did. All right, guys, so today was a lot of information. This is what we're going to be doing every single week, be able to give you more information about what's happening right now in this housing market, and then also bring you additional questions that I'm getting asked every single day from clients that are working with our team. If you do have questions, feel free to put them in the comments. I will go back and answer those as we go. And of course, as anything else, if when you are ready to make that move here to San Diego, have a question about your home financing, or curious about where to go when it comes to the area here in San Diego, feel free to reach out to my team here at the MortgageLiz team. Again, I am Liz Lepore, and thank you so much for watching our live. I look forward to seeing you here next week. And we're going to try it out here again on Tuesday, maybe even do a Monday. If there's a preferable day or time, feel free to put that in the comments. I would love to be able to hear it. So that way it makes it a little bit easier to know when to go on live here in YouTube, in YouTube world. So with that being said, thank you guys all so much and have an amazing night.